Hey, it's Jim, and this is level one of the CFA program, the topic on economics, and the learning module on monetary policy. Back in the old days, when I went through the program, monetary and fiscal policy were buried in a massive reading on macroeconomics. The Institute has done us all a favor by separating these two topics into two separate learning modules. However, remember, I warned you about this when we went through the fiscal policy learning module, that the LOSs are linked. Let me show you here. Look at this last one. Explain the interaction of monetary and fiscal policy. Now, of course, in this learning module, we'll focus on central banks. But let me just remind you that there are essentially two questions that the Institute can ask in both the fiscal policy and the monetary policy learning modules. Remember, in fiscal policy, we have lawmakers either increasing tax rates or lowering tax rates. We have congressmen and women either increasing their spending or decreasing their spending. So the question is, for fiscal policy, hey, what is the impact on those fiscal policy decisions on the economy? Well, the same thing holds true here. So here's the second question as it relates to monetary policy. Central banks can either increase the money supply or they can decrease the money supply. What's the impact on the economy? And so that's pretty much summarizes the LOSs for both the fiscal policy and now the monetary policy learning module. So let's get right into that first one. Describe the roles and objectives of central banks. Well, what do we know? That every country has a monetary system, and every country has some kind of a government institution that pretty much oversees that system. Of course, this government organization is called a central bank. So what do? They supply the currency, so they're a monopoly. I mean, I guess I could put out Jim's currency and see how far that would go. Probably get me arrested. It's a banker. The central banks, they're banker to the government and also the banker's bank. And notice what we have over there on the right-hand side of the colon, liquidity. This is a super important concept when it comes to monetary policy. Let's see, banker, fiscal agent, advisor to the government. That makes sense. Regulator and supervisor to the payment system and also the banking system. And that third from the bottom, that's probably an important one. The lender of last resort. Here in the United States, the Fed, I remember learning about this even when I was an undergrad, lender of last resort. And I remember my professor saying, well, the discount rate that the Fed charges its member banks is lower than the rate that they can get from each other. That's called the federal funds rate. And I remember thinking, well, why don't banks just then go to the Fed? But the member banks go to the Fed when they can't get money, when they can't access capital from all of their other friendly banks. So that's why it's the lender of last resort. And then, of course, you can't operate a system without worrying about what's going on outside of the system. So we got to worry about managing the currency, the domestic currency, as it relates to all of the other foreign currencies, and then gold reserves. Go back to from the period between World War II all the way up through the Nixon era, where we had, this kind of a gold standard. Now we're on a floating standard mostly, but there are some ties to major currencies. And then lastly, this is pretty much our focus on in this learning module, conductor of monetary policy. What did I say just a few minutes ago? We can either expand as the central bank the money supply, or we can contract it. How do we do this? Well, we set interest rates. So in the United States, the Fed has a target range for the federal funds rate. I said to you, and you should know this, that federal funds rate is just typically an overnight loan from one financial institution to another. And that rate, and we'll see this here in just a few minutes, that rate is like the indicator rate for everything else that goes on in the economy. So the central bank can either raise that rate or lower that rate. Or like happens pretty regularly, they can just say, we're not going to do anything with that rate. Open market operations, back in the old days, and I mean, like 50 years ago, what the Fed would typically do is they would just buy bonds issued by the Treasury Department. So they buy these Treasury bonds. So what happens? They take some of their capital and they buy these securities, which means there's a supply of money out there that's increasing. Or they can sell their securities, which means they're taking money out of the system. There's that second block point, adds or removes money from the economy. And then, of course, the Fed determines what that reserve requirement. I mean, if I'm Jim's bank and I take in $100 worth of deposits during the course of the day, remember that's a liability, so I owe those depositors that cash, and they can come and get their money at any time they want. So the Fed and central banks have a reserve requirement. They might say something like, you know what, Jim, if you have $100 in deposits, you need to keep $12 or $7 or $5 in cash, because some of those people are going to come back tomorrow and want their cash. Most of them won't. And so the bank can either increase or decrease those reserve requirements. I think this is the basic question that precedes the question that I was asking earlier in the introduction. And this is known as the monetary transmission mechanism. So we have this interest rate over here on this left blue box. So what can the Fed do? The Fed can either increase the official rate or decrease it. And it's going to have several consequences throughout financial markets. And then all the way over on the right-hand side in the yellow, ultimately it's going to impact inflation. So how does the monetary decision on interest rate changes, how does that get transmitted to when you or I go down to the food store and we want to buy bread and milk and cucumbers and whatever else we buy at the food store? All right, so what did I say just a few moments ago? That official rate, then, it has the impact on market rates. Now, it depends on the slope of the yield curve and what happens to those market rates. But if the Fed changes a short-term rate, that's gonna either increase or decrease the short end of the yield curve, which will probably have implications to the long end of the yield curve. So clearly it's going to affect market rates. And then, depending on that shape of the yield curve, it might affect asset prices. Of course, at the short end, like a treasury bill, it might have an impact. At the long end, with a treasury bond, it might have more or less of an impact, probably more because of duration and convexity. We'll learn about all that kind of stuff later on, especially in level 2. But once those interest rates change, and then once the asset prices, like bonds and stocks, and even collectibles and private equity, all those different kinds of asset classes, once those asset classes react to the change in the slope of the yield curve, then that impacts investor expectations. It impacts investor confidence. I mean, if I see the Fed raising interest rates and then I go down to the bank and I want to borrow money to buy a car and that interest rate is higher, and then I start thinking, whoa, what has happened to my retirement fund? Interest rates have gone up. I used to have $10 million in my retirement. Now I only have $7 million in my retirement. And by the way, I don't have $7 million in my retirement fund. But what that does is that changes my entire confidence level. So I may be less inclined to spend an hour surfing on eBay, which I used to do a lot, but I don't do too much. But I love buying old T-shirts. I buy T-shirts like, my favorite, one of my favorite rock and roll bands is Kiss. I love buying James Bond T-shirts. But if those things are going to be $30 and $40, I might not buy those. If they're $10 or $12, I might. So that changes my confidence, not just shopping on eBay, but shopping everywhere. And then, of course, I need to worry about all of the changes in expectations and how that impacts the exchange rate. What if I want to buy a James Bond shirt from a seller in London? This is a really cool shirt, but the exchange rate moves against me. And now instead of paying $20 to convert to the currency in London, I gotta exchange $40 or $50 or whatever it is. So you see how each of those things, they're going to have impacts on demand. And then overall inflation over on the right-hand side. Let's take a little bit of an example and a little closer look in all this. So look in the very top teardrop point. we're going to look at the red bold there. Consider a situation where the central bank increases its official rate. So that thing then permeates into the financial institution landscape. So all loans are more expensive. And then that's going to shift the yield curve upward. Maybe the yield curve has a steeper slope, maybe it has a flatter slope, but it's going to put upward pressure on all points of the yield curve. We'll have a great conversation in level 2 about key rate duration, and that's going to tell us where we want to borrow money on that yield curve and what that key rate is and how that key rate is reacting to things like changes in central bank monetary policy. So if that yield curve shifts upward, then when we use those higher interest rates to compute the price and the present value of, say, a bond or a share of stock or some other kind of financial security, that's probably going to lower the price of those assets. And what that does then is we're all stressed out about higher rates, lower asset prices, so that's going to change our attitude towards things like spending and investing, and that means that the economy is going to slow. And that has an impact. Remember, we have great conversations on financial statement analysis learning modules where slower economies then result in less revenues, maybe higher expenses, and then less net income, which ultimately means less operating cash flow. So then what that does is that those higher interest rates will tend to increase the value of the dollar, making all of our exports more expensive. So I think this is a really cool exam question. I would know each one of these columns because the Institute could give you essentially one question stem and then ask you 4 questions that follow up. Lending rates, prices, expectations, and exchange rates. So what happens then is that this increase in the policy rate tends to decrease domestic demand and net external demand. So think about, let me just go back here. Here we are kind of in the middle of this illustration. And then that weaker total demand will probably push domestic inflation downward. And all things considered, it might drive down those costs of imports, which would have negative pressure. So this is why in 2022 and 2023 in the United States, we have lots and lots of issues. Some people would blame it on the fiscal policy of the United States. The U.S. government sending out tons and tons of money because of COVID. Well, that resulted then in the summer of 2022 in tremendous levels of inflation, over 9% annual inflation rate during the summer of 2022. And then what is the central bank in the United States? What has the Fed done? The Fed has increased interest rates and increased interest rates. I have a colleague who is a self-described Fed watcher, and I wouldn't call him a Fed watcher. I would call him a Fed scrutinizer. He knows exactly what every Fed chairman has for breakfast every day, and so he tries to figure out what the Fed is going to do. I just kind of yawn and say, you know what, whatever happens, that's going to happen. I wish I had $7 million in my retirement account. All right, how about this part of the LOS about what are the qualities of an effective central bank? And I can envision the Institute giving you a question stem where it might say something like, hey, here's the Fed they're very transparent, regular reports. They tell you what's going on in the economy with inflation, with unemployment. They do this regularly and you can see it. And then they say something like, you know what, the investing public, the bondholders, we believe that the central bank has a fundamental economic reason for either, well, let me just go back here, doing one of these 3 things, right? So we have credibility, but then there might be a sentence in there that says something like, oh, the President of the United States and the Fed chairman, they spent the week together vacationing in Greece, and they had a great time, and they were seen going over an Excel spreadsheet, and someone saw them drawing a yield curve. All right, so you have to worry about this independence, right? Free from political influence. And I can tell you as a colleague of the Fed watcher, that this is a big issue here in the United States. Is the Fed truly independent from, Congress and the White House? I tend to believe that it is in a general level, but I always worry about it. I always take a pause. All right, so forget about my opinions. Don't worry about my editorialization there. But think about these three qualities. They're super important. And the Institute sounds to me like they love to give you 2 out of those 3 and say, okay, which one is the least effective decisions that the Fed has made? Now, what do we know? One of that very first slide I put up there, we had a list of bullet points of all the stuff that the Fed does. Somewhere down at the bottom, I think it might even have been at the bottom, we were told that the Fed, it controls the money supply. Now, what that means then is the money supply is controlled, and one of the measurements of determining the effectiveness of that money supply control is the rate of inflation. Over the years, the United States has had fairly tame inflation compared to other countries. You read in the Wall Street Journal, countries in emerging markets or newly developed markets have inflation rates of 50% or 100%. I can't even imagine what it means, going to the store and having paid $1 for a loaf of bread last year, and now it's $2 for a loaf of bread. But here in the United States, we've wavered between essentially 0% inflation, to 15% inflation back in the late 70s and early 80s. Go back to World War II and World War I. Those are kind of odd scenarios, so let's not even worry about those. But apparently, sometime when I was just beginning my graduate school days, there was this dude in New Zealand who thought, what, let's have a target range of around 2%. And that seems to have caught on throughout the world, this 2% target rate of inflation. It's kind of like the benchmark. And what that means is that the Fed then has to make these decisions so that the actual inflation doesn't deviate too much from its target. But you've heard me say this before. Whenever someone says to me, oh, that number ought to be 2%, I always ask myself the question, why not 3%? Why not 1%? I'm always of the opinion that why do we even need a target of 2%? Why can't we have 0% inflation? Well, that's going to show up here in a slide, because if you have 0% inflation, then there's a concern that corporations are not going to be able to find positive net present value projects and not be able to increase their revenues and increase their operating cash flows. That's what people think. That's what economists think. Me, I'm not an economist, so I just think, what, I'd like to be able to go buy a loaf of bread for $1 today and have it be a loaf of bread $1 next week and next month. Now, this inflation target strategy, of course, is different between and among countries. I've said to you guys multiple times in these recent recordings that I've been reading this Paul Volcker autobiography, and it's fascinating stuff in there. And one of the great things that I have learned is that he has made, I'm talking about back in the 60s and 70s, he made great friends, not only in the United States government, but throughout the world. And so these central bankers, it's not like they don't know each other, right? And so they have these different ideas about what it means to have an inflation target rate, but they're all pretty similar, and they all probably have the same kinds of ideas because they're economists. They all went to, great schools of economics, and so they probably think in a similar manner. So there we go. Look in the purple there. We cannot set it at 0% because it might lead to deflation. Now, what the Fed also does is says something like, There are lots of things that influence the price of a loaf of bread at the food store. What we're going to do is we're going to take the long-term approach to all of our policies, because just like we learned back in the fiscal policy learning module that Congress can make a change in the tax rates, and that law might be in effect today. It might pass today, but it won't take effect until next year or 2 years from now or 5 years from now or whatever that is. So there's always some kind of a lag, and that holds true with monetary policy as well. Although changes in interest rates and asset prices, that happens a little bit more quickly. But look at the bottom. Yeah, it will require time to fully impact on the real economy. All right, how about exchange rate targeting? This is one thing that presidential candidate Donald Trump emphasized when he was running for president. He kept saying things like, we're very patriotic, made in the United States. We want a strong dollar, right? Strong dollar, strong dollar. And that sounds like a great idea. But this is what we know. We know that, of course, for U.S. firms who operate on a global basis, they benefit from a weaker U.S. dollar when those revenues are generated in another country, and then that currency is translated back to the United States at more U.S. dollars, the weaker currency. So this exchange rate targeting is really nothing more than a balance. Marginal cost, marginal benefit. Now, of course, we need to take a long-term view over this and how it impacts inflation over the long term. And so what the Fed essentially does is say something like, let's take the exchange rate of the dollar between the euro, and we have some kind of a range. Now that range, do we want it to be too wide? Probably not. Do we want it to be too narrow? No, we don't. But once it starts bumping up against those limits, then what the central bank can simply do is just enter the market, and they can either buy the currency or they can sell the currency to bring it back into that narrow range. All right, let's take a look at a quick example. We have a nation peg its currency to the U.S. dollar, so we have similar inflation rates, consistent relative price levels. So if there are no unforeseen economic disruptions, then that currency should remain in its targeted range. When do we have no unforeseen economic disruptions? Probably almost never. All right, so what happens if this developing country economy accelerates, right? And the inflation rate is 10% and the US inflation rate is 5%, then its currency, of course, is going to lose value against the dollar. So what that central bank will do in that country is just step in and sell its currency, and buy its currency, right, propping it up, and sell its foreign reserves. What will happen then is that increase of the money supply will lead to a drop in interest rates. Now, we need to figure out this in kind of a global context here, those domestic economic conditions, which include things like, the interest rates and the money supply, must then change to support, going into that narrow range. So we need to think about, all right, if the central bank is going in and either buying or selling its own currency, well, that's going to have an impact on the exchange rate. And then that's going to have an impact of all these other countries who are saying, wait a minute, imports or exports, are they more expensive? Are they less expensive? And so that's going to impact the trade deficit between and among all of these different countries. And we have some examples there on the slide about pegged currencies. So in summary here, this is the slide that's important about my very first question. We need to know what happens if we increase or decrease the money supply. Is it expansionary or is it contractionary? All right, so look up at the green. Expansionary policy. What are we doing? We're expanding the money supply. How do we do this? We reduce interest rates. How do we do this? We decrease the reserve requirements. How do we do this? We buy securities in the open market. Each one of those central bank policy decisions is going to essentially put more cash into financial institutions. When the financial institutions have more cash, what they do then is that they make that cash more available to people out there like you and me. And so if the interest rate on a car loan is 0%, I may go out and buy a new car as opposed to 5 or 10%. Now, go ahead and stand on your head, look down at the red box, contractionary policy. If the Fed or any other central bank wants to decrease the money supply, well, they're going to do just the opposite of what we had up at the top. So it's probably worth, It's probably worth taking a picture of this slide because I can't imagine the Institute would offer questions on this learning module without including expansionary and contractionary, either question stems or 3 multiple choices. Now, of course, I'm not here to guarantee you that. That's just my own kind of an opinion. Remember, the Institute has its own thought process and its own ideas. Reminds me of George Costanza when he was dating that girl and he couldn't figure out what she wanted, and she looked at him and said, "That's because I'm an enigma." And that sounds an awful lot like like central banks. How about this concept of a neutral rate of interest? So this means that we're not expanding and we're not contracting, right? So we look at those high and low policy rates as being relative. What we want to do is we want to have an interest rate that neither stimulates nor restrains economic growth, kind of like allowing the economic system to function on its own. Now, there are 2 components of this neutral rate of interest. This is the real trend rate of growth in the underlying economy. That's what I was saying about how when I did this with my hands. And then the long run expected rate of inflation. Because, short-term inflation can go like that. But what investors, bondholders in particular, are interested about that long-term sustainable economic growth as it relates to prices. So we want stable inflation over time. And this is what I know, is that investors in general are willing to tolerate changes in short-term inflation as long as it believes the Fed has long-term inflation under control. And this is pretty much what the Fed tries to convince us. All right, so let's do a quick kindergarten example from a mathematical standpoint. Be awesome if the Institute gives you this question. So if we have a target inflation of 2% and the long-term growth is believed to be 1.5%, then that neutral rate is going to be 3.5%. So what does the Fed do? What do central banks do? They make decisions that say something like, boy, we don't want that rate to be 4.5%. We don't want that rate to be 2.5%. Now, what was I saying earlier? I was saying earlier about stability and sustainability, supply and demand, and so we need to consider what about a demand shock and a supply shock. So I have lots and lots of examples that I give my students. I know many of you who watch from throughout the world are not golf fans, but I always use this example, and I think it's a good one. From the demand side, what happens if we're watching a major tournament? So people from all over the world should know about the US Open and the British Open and the Masters and the PGA Championship. So what happens if a golfer, it could be a famous golfer, but it doesn't have to be, wins this tournament by doing something unusual? Maybe this person has used a golf ball that is slightly different. Whatever that slight difference is. And so after he or she wins this tournament, they come on a commercial and they say, I could never have done it without this golf ball. See the dimples here? The dimples are just a little bit different than all the other players. All right, so this is a demand shock. What would we do as golfers throughout the world? We would run down to our local golf shop and say, give me a dozen, give me 2 dozen of those golf balls, right? All right. Now, supply shock, on the other hand, is what happens if we're just regular golfers and we need a dozen golf balls, and we go down and we see this golf ball and it has these dimples on it, but there are 1 million boxes of a dozen golf balls on the shelf. There's a demand shock on one hand, there's a supply shock on the other. Of course, if we see 1 million of those boxes, the price is going to be super low. All right, so let's go ahead and analyze my little golf example as it relates to central bank behavior. All right, so if we have this demand shock, whatever it is, so inflation, right? We're down there, we're fighting over these golf balls, so the price goes up. Well, then the Fed needs to tighten the monetary policy to bring those inflationary pressures under control. If, on the other hand, there is this supply shock, right? So look at the example we have there. A significant jump in oil prices because there is maybe those oil producers, they say, you know what, we're going to turn off all of our oil wells for a month, right? So there's going to be a total drop in supply. In my golf course example, there was a tremendous increase in supply. All right, so what happens there? Well, we need to have these consumers who are facing higher prices in the jump in oil prices or lower prices in my little golf course example. So we need to do something there as the Fed. Now, one of the really cool things about reading this Paul Volcker autobiography is that both Paul and other super smart economists throughout the world, they always say things like, oh, well, I hope this works, or boy, what about this, or what about this? So economists, they're famous for being right 50% of the time. So what are the problems here? And these are great exam questions. So look at that first arrow point. They might not permeate the economy as expected. Now, the founding fathers of finance, they had some really, really restricting assumptions, like investors have perfect information, they have access to that information, they process that information in the same way. So let's translate that into the bondholders and the bond market. Well, what might happen at the low end of the yield curve might not happen at the high end of the yield curve. So that might not have the desired result depending on whether the middle or the two ends of the yield curve dominate the reaction to this monetary transmission mechanism. Now look at the bottom. This sounds to me like a great exam question. There's this liquidity trap. We've had this in the United States, over the last, well, not the last several years, but, in the early 2000s and 2010s. Suppose interest rates are really, really low. Well, what are we thinking as consumers and investors? Well, what we're saying is that, I'm not going to take any of this. And I'm not going to go out and invest in bonds because if interest rates are low, there's no way that the central bank can continue to lower interest rates. I mean, you can't come out and say, the Fed can't say, hey, I think our target Fed funds rate is going to be a minus 4%. I mean, you just can't get away with negative interest rates like that as a policy. So what happens then is that investors will say something like, you know what, I'm not buying bonds. I might not even buy shares of stock. I'm just going to start hoarding cash. I'll keep cash on hand in case I need it sometime in the future when interest rates go up, because I'm pretty sure they're only going to go up. Then I'll buy those bonds because then I could benefit when interest rates fall. This is called the liquidity trap. And so this has some repercussing consequences in that, all right, I'm not going to spend the money in the bond market, probably not going to spend it in the stock market. I might not even spend it in the car market or the housing market or maybe in the food market. So we have lots and lots of cash on hand, which then means that whatever monetary policy that was in place, that's probably ineffective. And it could cause deflation and recessionary consequences. Yeah, here we go. Slashing interest rates near zero or below zero. There's no way that's effective. So what does the Fed do? Well, they do this thing called quantitative easing, right? The Fed can go out, and what did I say earlier? The Fed has traditionally bought Treasury securities, but after the 2008 financial crisis, it started buying mortgage-backed securities, and there's no telling what the Fed could do. I mean, this quantitative easing, it could include buying shares of Amazon or Apple. I mean, it's still the Fed taking its capital and putting it out into the bond market, but then there's no reason why it can't do into the stock market. I mean, it could buy collectibles. The Fed could go out and buy a James Bond t-shirt, right? And that would increase the money supply. So large scale asset purchases. I'm guessing the Fed is probably not interested in buying a James Bond t-shirt. But I'm betting that those people on the Fed, I bet they watch James Bond movies. All right. Challenges in monetary policy in developing countries. So why does the Fed here in the United States have such incredible leeway? It's because, we have Treasury securities. We have, in 2023, there were 32 or 33 trillion dollars worth of U.S. Treasury securities that were outstanding. Plus, we have this tremendously mature interbank market. We have struggles with inflation, but not nearly like I said earlier. Some countries have 100% or 200% inflation. True independence, this links back to what I said earlier. Rapid changes in financial methodologies might have implications for what is the definition of the money supply. Back when I was in college 100 years ago, we had the M1 and the M2, and that was pretty much stable back in those days. But now, even remember, I'm not an economist. I'm not even sure what goes into M1 and M2 and M5 and M10. Those things change because, there are lots and lots of tremendous financially engineered changes in the financial institutions market. So when the Fed goes out and buys, takes the long position in a futures contract, boy, what does that mean? Is that increasing the money supply? Is it decreasing the money supply? So we need to hone in on what that definition of the money supply is, not just for our country here in the United States and, other developed nations like Japan and those countries in Europe, but that's an even bigger deal for developing countries. Now let's get to this last one here. This is the great question that I've been warning you about for 2 learning modules. What happens when monetary policy and fiscal policy, what if they agree with each other, right? Or what if they disagree with each other? One could be expansionary, one could be contractionary. These are not perfect substitutes for each other. So notice you have these 2 people pushing against the economy. So what are those implications here? So let's do this. Suppose at the top, look at the blue, we assume that wages and prices remain fixed. Oh boy, that's a huge assumption, but this is one that the learning module makes. So we have an easy fiscal policy and a tight monetary policy. What does that mean? Reduce taxes or increase government spending. Well, what's going to happen? We'll probably have aggregate output will rise. Interest rates will probably increase. And then government spending, this becomes a huge part of GDP. On the other hand, suppose we have a tight fiscal policy and an easy monetary policy. What's going to happen? Interest rates are going to fall. Private sector gets a boost because of those lower interest rates and lower borrowing. What that does is it reduces the weighted average cost of capital for these companies, which means their net present value of all their projects goes up. And that means that the private sector has a greater impact on GDP. Public sector diminishes. How about easy monetary policy and easy fiscal policy? So look at that first point. Highly stimulative, right? We have both ends of the government saying, we agree. That's going to end up increasing aggregate demand, right? We're not only going to go down and buy golf balls. We're going to go down and buy cars and houses and apartment buildings and all different sorts of stuff. So that's going to increase aggregate demand, which will potentially reduce interest rates, and we'll have expansion there. If we have tight monetary and tight fiscal policy, then interest rates are probably going to increase on both sides, and that's going to reduce aggregate demand. Probably means that we're going to have increase in tax rates and reduced government expenditure. So there's decrease in aggregate demand. All right, so that was a pretty fun learning module for me to talk about. What I want you to do is go to the end of the learning module. I think there are 15 questions. I guarantee it won't even take you 15 minutes to do this if you paid attention here. It's pretty straightforward stuff about expanding and contracting. You'll see what I mean. So hey, thanks for watching. Have a great day and good luck studying.